Hello, my name is Joaquin Bravo, and I'm joined by
Moniz.
Yuxin Tao.
William Meyerpeter.
Mohamed Mahamed.
Yousif Hammoudeh.
Anthony Dougherty.
and we are Iconic Footwear. Very quickly, this will be how our presentation will be conducted, beginning with our company, the strategy, our internet and wholesale markets, our private label market, our production strategy, our finance strategy, our stock price and return on equity, our annual image rating, annual credit rating, and finally, our conclusion. Here at Iconic Footwear, we focused on providing high quality shoes that include great designs. We price our products at a price we believe represents the quality and image that we strive hard for to maintain. We offer 500 models in the North American and Asian Pacific markets, 384 models in the European African market, and 50 models in the Latin American market. Our production was based in the Asian Pacific, Latin American, and European African regions, with the Asian Pacific plant being the most competent. Our main overall strategy focused on differentiation. We wanted to provide high quality shoes and a lot of models to offer a variety of unique styles. Interestingly, throughout the course, we analyzed our company's performance and incorporated other strategies such as cost leadership to various aspects of our company in order to be more successful. Our main direct competitor was Company J, but we also had others such as Company G and D, among others.
We will now be going over the internet and wholesale market segment. For the internet and wholesale market segment, our goal was to spend a lot in advertising to create brand awareness. We wanted to use the internet and wholesale segment to showcase our high quality shoes. In these segments, we also kept our prices slightly above the industry average in all our regions. Because of the quality of our shoes and the superior materials that we were using, keeping our prices above average helped us to sell and make a profit off of our shoes. This slide is the amount that we invested in our marketing in year 20 for the internet and wholesale segment. Highlighted in green is the amount we invested into brand advertising, and in white is the industry average. As you can see, our marketing prices are fairly high compared to the industry average. We started this strategy in the beginning and we slowly increased it. But towards the last couple of years, we tried to match it to the industry average to gain more customers. Our prices and high marketing costs throughout all our regions allowed us to create brand awareness, and it also helped our company to raise our ending cash flow, which allowed us to spend more money on other things in our company.
For the private label market, we started with the strategy of differentiation. So we started in selling shoes in Europe, Africa, and Latin America markets. Then we expanded to North America and Asia Pacific in year 13. When we evaluated our performance in year 14, we figured out that it was difficult to earn more market shares with high SKU rating and high price in this segment. Since the rule here is the player with the lowest price sells more shoes, and the labor cost and transportation costs for our main competitors, such as Company J, B, D, and H, are much lower than ours. Therefore, we decided to switch to cost leadership strategy by lowering the SKU rating to 5 in all 4 markets. In addition, our goal is to make at least 20% market share in North America, Asia Pacific, and Latin America, and at least 40% of market share in Europe, Africa, because the profit with the same SKU rating of other regions is the highest. So here, our strategy is also cost leadership. In the first few years, we used differentiation to make our shoes stand out with a high SKU rating of 8.9. However, after evaluating our performance, we found that we had little competitive advantage over our main competitor, Company J. Therefore, we decided to add cost leadership by lowering SKU rating and lower labor cost, percentage of superior material used, and cost of enhanced style, as well as lowering the price to gain more advantage. We also arranged the base wage, incentive pay, and best practice training fee to get the ASCII rating of 8 with the lowest labor cost. We also upgraded our machines, and we decided to produce shoes in Asia Pacific to meet the demand of the branded footwear in North America, Europe, Africa, and Asia Pacific. And the Latin America facility produced shoes to serve itself. Also, the Europe Africa facility only produced shoes to meet the demand for the private label in the Europe Africa market to avoid high tariffs.
As we begin to look at our financial strategy, or our finance strategy here, as previously mentioned, we started off with an initial strategy of differentiation, and we started off pretty aggressive with our loans and production of facilities. As we move to a more cost management type of strategy in areas such as the chart here that shows the private label, you can see a significant drop off between year 16 and down towards 18. Here in the private label sector, we saw the market evolving year by year, and it became areas such as this were not where we wanted to be producing and competing with things. We instead decided to compete with other companies in areas such as wholesale and the internet parts of the market. On this next slide here, we can see that our overall revenues have gradually increased over time, and our internet sales have increased significantly as we began to focus this in earnest. With our constant and significant shifts with where we focused our market at the time, we've attempted to capture an increased market share in all of our target markets, no matter what part of the world they may be in. In addition to this shift, another factor that led to our decrease across the year 16, 17, and 18 for revenue was the fact that we were not running at maximum capacity. We had machines aged to a point that they were no longer functional, and so we had production space, but we did not have equipment to produce product. After readjusting our focus and ensuring our production needs, we were met with an increased growth, and we were able to continue pushing forward into the internet sector with even more growth expected in the future, as we can see with this upward trending line in the internet sales department.
As you take a look at our return on equity, obviously at the beginning of our company, we looked at different things, and we decided to take a loan in order to upgrade our facilities. That kind of lowered our return on equity. But as you know, as we increase our profits and our revenues increase, we hope to pay back that loan. So hopefully that would help us increase our return on equity. On top of that, because we issued some common stocks, that also was the cause of this downward spiral that you see on year 17 or so. Our earning per share has been steadily improving, and we're on an upward trend right now. We had a rough patch, and as I stated before, that was because we wanted to buy new equipment, and so we issued new stocks. And when we issued the new stock, that kind of lowered our earnings per share. But as we buy most of our shares back, that should increase our earning per shares. Our stock price has been kind of inconsistent, and that is also because of the stocks that we issued. Even though we had a lot of stocks out, because there were so many, we couldn't really get a lot of our stocks weren't attractive enough because of course, the loans that we took out and all those kind of things. But our profits are increasing, our revenues are increasing. Hopefully we can start paying dividends and make our stock attractive again, and that will help us increase.
Our initial strategy with Iconic Footwear was to focus on the quality of the footwear itself. We put a lot of money into increasing the styling and quality of our product. This initial investment in our shoe quality and style brought us up to one of the first and one of the only companies to have a perfect image rating early on. However, after some analysis at the end of year 13, our company decided to take a look at our strongest competitors and adapt our strategy. Our direct market competitor was Company J in the wholesale market. a company with a near flawless image rating. While we matched Company J in quality, they had better model availability, better brand advertising, better celebrity appeal, and a lower price than our shoes. In the private label segment, while our quality was way higher than Company J, they priced their shoes 1 cent lower, leading to us having the same demand but making less profit due to our high costs. This analysis of our direct competitor presented us with a very important decision on the direction we wanted to take the company in. Instead of trying to compete against one of the strongest companies in the market, we instead chose to lower our production costs to increase our profit margin. This meant that we lowered our shoe quality and styling to reduce costs. We maintained our image rating at a reasonable level, ensuring that our company image doesn't fall below any expectations. Here at Iconic Footwear, we firmly believe that the employees are a company's greatest asset. We want to attract and retain the best employees we have, and so we always make sure to treat them fairly. We invested in ethics training immediately and improved working conditions to ensure that our employees were happy. We also made sure to pay our employees fairly, offering incentives and training throughout. As you can see, our credit rating has been fantastic in the last few years. Our strategy was to take out large loans early on and invest them into the company. This was a long-term strategy and it paid off. All of the investments we made within the first few years, such as putting money towards employee programs and facility upgrades, made us a larger profit by year 20 than we would have made without them. Investing in those facility upgrades as soon as possible was vital, as they saved us money every subsequent year after they were installed. Once our company started to become very profitable, we paid off our bank loans and collected the benefits of our long-term plan, increasing our credit rating in the process.
So, in order to summarize Iconic Shoes, we focused our strategy on differentiation. We implemented various strategies to achieve this goal. For product differentiation, we wanted to make sure our product represented great quality. We invested in a lot of higher quality material throughout the years. For price differentiation, we made our costs slightly higher than the industry average, and continue to lower them to attract more customers. We also invested a lot of money in our marketing and advertising. And in the end, we just wanted to create a strong brand awareness for our company, and we were successful in doing this. That's all I have.